Welcome to the Private Equity Exchange, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. With over 1,000 delegates, the Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet. Before the event, using our internet platform, schedule one-on-one meetings with delegates that matter most to you, and exchange far more than business cards at your deal meetings at the Private Equity Exchange. Gather great market insight with over 120 speakers and 6 tracks to choose from. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. You are looking at LBO for Professionals, Leverage Finance Future, Innovations and Trends in Europe. Introducing
Welcome everybody, my name is François Guichot-Pèrere, I'm working for Royal Bank of Scotland in Paris. I think I try to summarize for you the main change for this year if you compare to the previous year. So first one is innovation in debt structures. Of course, from my point of view, but you are a very famous banker in this room coming from Société Générale, for instance, I can see him, or Calion, so we can have a debate on this point. I mean, the main change for me is perhaps not the level of the leverage, even if for the first time on the French market, I think in 2006, we have been above the 8. And it was 7 1 year ago for the most aggressive deals. But I will say from my point of view, the main change is perhaps the full bullet tranches that we have now on some deals coming from mainly the TMT sector. And now you can see that on, I will say, a standard deal, not only a TMT deal. It's the first, from my point of view, is the first main change that we have, and perhaps the main change because it's true that we all know in this room that we have some deals in, I will say, in our luggage going to the market in the next coming months will be full bullets without any tranche A. That's, I think, the main important thing. Why? I will say the second point is explaining this reason. It's the liquidity market. I will not, give you some tarte à la crème regarding this point, but what we can say is in 2002, in the French market, we had, for instance, Le Grand Deal. Quite proud as French to have done this one. And we had, if I remember, 130 banks or CDOs in the syndicate. I think today, I will say a deal with 1 billion euros, total debt. It's mainly 220 or 225 banks and CDOs in a syndicate. So in 4 or 5 years, you double the number of banks and CDOs in your deal. On the leverage, if we can come back, my point of view is that we always, have a look on the most famous deal or the most, I will say, trophy mandate that we have. So it's clear that we are now above the 8-point EBITDA multiple. Nevertheless, don't forget that we have a lot of deals between 50 million euros total debt and 200 million total debt, which are, I will say, roughly around 5 multiple EBITDA. In the same time, the pressure on pricing, of course, is increasing. The standard now is, as you know, all of us, it's 200 for tranche A, 250 for B, and 3 for C. That's the standard, so it means that you can have some example, under this market standard. On the other hand, I will say that, from my point of view, the main pressure is on upfront fee. For primary deal, but mainly for secondaries and third buyout, and of course for recap. We'll go back on this point after. On this point after. P2P increase, yes, sure. In 2006, And I think you will have more P2P in 2007. It's our point of view in RBS. I don't know if our colleague from Cartier-Millon, Société Générale, and the other banks in this room have the same view. One perhaps point a little more aggressive for us is that more and more equity sponsor, planned some asset disposal in the deal, and they ask us early when we worked on an origination side with them to split the proceed between them and us before we start the deal. So they said that we want 50% or 60% of us for we saw a kind of automatic recap. And we have this pressure coming now. Speculative or mature bank market. I think my point on this one is perhaps we are more and more professional. I have been very surprised to see that in 5 years, people in lawyer firm, in audit firm, transaction services and so on are more and more professional. And of course, I hope in the banks. On the approach of debt pushdown and securitization, it's true that it's perhaps also a main change between 2006 and 2004 or 2005. We have, for tax efficiency reason, more debt pushdown than before. I think all our deals now we try to do some debt pushdown. And we try, but you have most famous banks than mine on this point, securitization. In order to reduce overall, I will say, the cost of the debt. It's true that you had the famous Fréquin, which have been done by Cartier-Millon. You had Cegelec, which has been done also by Cartier-Millon. You have other example. I will say it's truly fair to say that it's quite time-consuming to do that. I think some colleagues can explain better than me this point. Nevertheless, which is interesting now, it's on secondary market. We can do some secondary buyout, just with I will say the target to maintain the securitization, so to just put a new senior tranches and a subordinated tranches. I don't remember if we have another slide. It's finished? So the impact of interest rate hikes, I will say the private equity are very clever. So they put a lot of pressure to the management to hedge their exposure, of course for the 3 years coming, but I will say sometimes for 4 years. And when they just reach the end of the hedging period, they are sometimes doing a new hedge if they have always a deal in portfolio. I will say for us today the increase of interest rate is not a main trouble in our case. You know that we have a very low level of default in France, as in some other countries. Perhaps you will have some impact for the mid market or the small market. Perhaps a little more anxious for that. On the high yield market, we have more and more FRN. Why? Just because in 2002 on Legrand, for instance, and after in 2 and 3 other deals, you had some penalty to pay, when you repaid your high yield, which was crazy. For instance, the Legrand level was roughly around 250 million euros just to repay the bonds. So the management and the private equity house ask us to do FRN more than high yield. I think for me, that's it. Just on recap, quickly, it's cheaper and more bullet. It's really cheaper. I'm quite afraid to say that in 4 or 5 years, the upfront fee decrease by more sometimes than 50%. We have always some difficulty as banker, to understand the notion of implied equity, because it's for us no more money. So we are sure that if you have no more equity in your deal, not sure if you have some trouble that you will put some new money, even if we like you, but we are sometimes a little, I will say, anxious regarding this point. What is the key thing is that more and more, a recap. It's just, the antichambre, I will say, of a secondary buyout. Clearly, you have a pack of due diligence. Immediately, you have some guys who can try to do a preemptive offer, and we are seeing more and more this phenomenon. On the other side, what is new perhaps in the French market, more than in UK market, it's the all senior refinancing, which are doing, at a quite high senior level of leverage, above 6.5, and a full senior with quite aggressive margin, around 175 for the tranche A and 230 something for the tranche B. So it's just tranche A and tranche B. At the end, I will say what we are ready to do now. I think the main change between 2002 and 2006 is to understand in our credit committees that, okay, we put a lot of debt perhaps at the start. Before we try to have to avoid any refinancing risk at the 8 or 9 years. Now we understand that perhaps after 5 or 6 years or 7 years, it's not nonsense to have a company with debt, with a debt, so a remaining debt. So that means that we accept more and more refinancing risk, and I think that's the main trend in our market.
Afternoon. I'm going to take a little bit of a different approach to François and also to my legal colleagues who are coming later. You'll see that my slides are very thin, 2 or 3 bullet points, and I'm just trying to throw some ideas and questions at you, play a little bit devil's advocate about what's going on in the leveraged finance market. Just very quickly so you understand the perspective that I'm coming from. I'm not a big bank, I'm a little fish in a big pond. We're a mid-market provider doing mid-market transactions, independent mezzanine. So that's the perspective that I'm coming from as I throw out some thoughts about what's going on in this market of ours. Move to the next slide. Obviously, as François said, the biggest and most obvious trend is the bullet debt fashion, and we'll come back to that. And it's not just the telecoms world. It can be all sorts of deals. There's been I think a furniture deal up in Scandinavia, and so the idea that you actually have to repay some debt during the life of the deal has gone now. It's a little bit like, in London I bought my house with an interest-only mortgage, and it's great. I don't make any repayments, and I cross my fingers that the house prices stay good in London, and I'm okay. And that's the way we're all doing our leveraged buyouts nowadays. We don't have to look at the business and see whether it can repay debt. We have to look at the business and say, will somebody buy it in 2 or 3 years' time for sufficient money to repay my debt? And by the way, we're doing it at ratios which are beyond which people were buying businesses 3 or 4 years ago. So it's sort of interesting. We've now got debt multiples at levels higher than purchase price multiples of 3 or 4 years ago, and we're relying on somebody to buy the business to take us out. So that's the market we're looking at today. Is that healthy? Well, if everything stays okay, I guess it might be. Record levels, I just took this from some Fitch report I was looking at. I mean, it depends how you look at debt EBITDA, and we shouldn't look at it as averages and statistics. We should hopefully look at it as what makes sense for the underlying transaction. And there is a very big difference between the big cap deals and the mid-market, or is there a big difference? And one of the trends that we're certainly seeing at the moment is the big name deals create a certain sort of benchmark which the market get used to, and before you know it, very similar multiples are being used at deals a fifth the size. Not quite the same. We're still lower down in the mid-market in terms of total debt to EBITDA, but we're influenced. There's a trickle-down effect going on, and so if it's a little bit like big businesses, solid, we can put lots of financial leverage on that because the business is solid. Suddenly we've got mid-sized businesses, not quite so solid. Let's put the same amount of leverage on them. So there's in my mind, a trend now, as we say here, mid-market deals with big company debt structures. And, there's the reality. Mid-market companies are not as strong. You take on 2 types of risk when you lend money, financial risk and operating risk. The mid-market's got more operating risk. It should have less financial risk. I'm not sure in some of the deals we've seen over the last 6 months that that's necessarily the case. The final point had been made by François, so we'll jump on anyway. So who's doing all of this? Well, yeah, François arranging it and taking his fees, and then syndicating, and that's great. And there's all these people who want to buy debt at the moment, hedge funds, CDOs, CLOs, huge liquidity, and a mentality which is different. It's not a bank and a credit committee. It's an investing institution. It's an institution which is ready to take on more risk and accept high debt multiples. I'm obviously out of time. I thought 170 was the record. We're at 220, obviously, in the numbers of lenders and investors who can be in one large deal. That's extraordinary. Just imagine what happens when that deal hits a few bumps and needs a few waivers. I mean, I know that the lawyers will talk a little bit about what sponsors are trying to put into the documents to protect themselves about the who owns your debt problem. But it's a very real issue, which I think will be a much bigger issue going forward, that deals which need some work done on them, it's going to be very hard. I think if I was an advisory firm in the distressed debt world, I think I'm going to have a lot of business in the next 2 or 3 years. When we look at the speed that we're meant to work now, it's incredible. We're meant to follow an auction process which is very fast. We get our one management meeting where the management have been trained with a nice PowerPoint presentation to make everything look beautiful, and we've got to go very fast. And if you're financing, you're often asked by a fund, we want to preempt, we want to go fast, we want to do this, we want to do that. So huge pressure, I think, on financing institutions who want to stay in the market to cut corners, to get the work done and not dig as deep as they wanted to. Now, clearly, a lot of deals, particularly in the French market, are secondaries, tertiary buyouts. We all feel we know those deals. They are probably on balance less risky, but I can tell you from personal experience they're not always less risky. And they're being done very fast, lots of preemptive bids. And clearly the funds now are happily saying, we own the shares, the rest is over to you. So there's a risk as well, a greater risk in the way there are no more reps and warranties. And ultimately what's driving this market, what's happening at the moment, in the old days, call me old-fashioned maybe, but you'd look at a business, you might look at some comparables in the stock market to try and get a sense of value. You might even do that old-fashioned thing called a discounted cash flow analysis and work out what the intrinsic value of it was. And you just try and get a sense of the value. And once you've got a sense of the value, you would then go out to finance the deal. What's happening now is that the bank's syndication committee says, who can we sell how much debt to and how should it be structured? Well, on this asset, we can do X times EBITDA. We'll go, no tranche A, B, C, second lien, warrantless mezz, PIC, package it up beautifully. And the sponsor goes, well, here's my debt. I better add 30-odd% to it for my price. And the deal is done. Who's really setting the prices today? I'm not again saying every deal's been done that way, but our sense a lot is that it's the lenders driving the prices rather than either the real underlying value of the business or it's not the corporate financiers anymore, it's the lenders. And when I say the lenders, it's the buyers of the debt, the hot money, the hedge funds who at the moment are very keen to buy leveraged debt. Interesting. I'm a mezzanine guy, so I've quick slide on what's happening in mezz. I think we're a segmented market today where the vast majority of it is being done by the banks, warrantless, nothing interesting to say about it really. For the independent mezz guys like myself, we have some comfort a little bit that we've got very wealthy management teams coming to see us now saying, we don't need to see your equity sponsor anymore, we can buy 50% of the business, can you help us buy it? That's quite good fun. We say first examples, we actually did our first deal of that type in 1991, but there's more examples now. And then at the same time, you've got this interesting dynamic of people like European Capital just coming along going, I'm buying the whole deal. So while they're driven by mezz first and foremost, that's their main product, they're just buying the deal. And that's an interesting trend. So I've got a little bit of a jaundiced view of the market, as you can tell at the moment. And so I just want to leave you with these sort of 3 questions to sort of think about. Do we believe there's still a credit cycle? If so, where are we in that cycle? And what might be the implications if we are actually at the top of the cycle? What could cause a market slowdown? Does it actually matter whether anybody repays any debt or not before it's repaid? If 3 years into the deal, you just do a secondary buyout and it's done. Does it really matter? And does it really matter if you've got a couple of hundred institutions owning all your debt as a shareholder? Do you care about that? It seems at the moment that the answer to those questions from most people in the market is none of these things matter. I would take a contrary view. Thank you.
I would try to complete what has been said by François and by Richard. In fact, what I understand is that there is not really nothing very new in 2006. I think it's very close to the topic we discussed last year. Something which has been new for us, maybe it's the trend of the securitization, maybe the whole business securitization. We have mentioned the Fréquin transaction before, and so currently Fréquin is maybe going to be sold or will be an IPO will be made. I don't know if a final decision has been taken in this respect, but clearly that could be a new trend, and there has been a quite similar transaction, which is a significant transaction on the French market, which is the Europe car deal, and which was quite interesting because you have 2 capital market transactions in this LBO financing. You have the whole business securitization, which is not yet refinanced because on the first place you have a bridge to asset financing, which would be reimbursed by way of whole business securitizations. And you have also a high-yield bond issue at the level of the BidCo company. And I think for me, I don't have any other example on the French market of a transaction where you have both high-yield notes issue and whole business securitization. And that was, for me, a new transaction in 2006, which was very interesting because also I think it was the first time that we have tried to elaborate on what would be the relationships between the bondholders in connection with the high-yield note issues, and also the expectation of what would be the expectation of the note holders in connection with the securitization transaction. As it has been said by François, it's in any case a quite difficult transaction to be implemented. It takes time. And because you have many people involved in the transaction, you have the rating agency, you have the monoliners, and so it's a complicated transaction, specifically if it occurs on various jurisdictions. But we see, for example, in the Fréquin deal, it was very interesting to see that in connection with a secondary LBO, which will occur or will not, depending on whether there will be an IPO or not on the company. All the potential acquirers of the company seems to be very interested by the whole business securitization. But Europcar and Fréquin are very interesting examples, but it's clear that in both these companies you have a lot of assets to be financed, so it's really linked to the asset to be financed. And also you have rentals, so you have the proceeds come from the lease rentals of the vehicles to the final users of the vehicles. So it was you have all the feature, in fact, to put in place a whole business securitization. Otherwise, I would say that the trend in 2006, I don't think there are many things very, very new. I think I'm mostly acting for banks in connection with LBO transaction. What I would say is, first of all, we are still in a very short process today. So I think the ability of all the people involved in this transaction, the banks, the lawyers, to be in a position to perform the transaction very rapidly is something which is very important for the sponsor. Also, we still have a great pressure on the strength of the commitment of the banks, and I think the clause, for example, of certainty of fund now requires in, I would say, almost all the deals. For me, one of the trends of 2006, and I don't think as a lawyer it's necessarily a good trend, is that what was required in large deal, and maybe we could understand the rationale to have this type of clause for a large deal, is now required even in the mid-cap market, which is not necessarily required, I think. And for me, for example, certain fund provision, it's a very good example, because obviously at the beginning it was mainly in P2P, where by definition you need the certainty of fund because there is an undertaking of the presenting bank vis-à-vis the market to purchase the shares. So in any case, the presenting bank is bound by virtue of the law to purchase the shares. And now it's not just in P2P. In fact, in all private deals, even in the mid-cap market, you will have a certainty of fund provision, which are more and more strong for the banks because there is no draw stop events which could allow the bank not to make the funds available on the closing date. Otherwise, we discuss about the recap that push down. I think on a legal point of view now, this issue appears seems to be very standard. For example, nobody has an issue as it was maybe the case some years ago about the possibility to make a recap or a debt push down. The issue is still about whether it complies with the corporate interest of the company. But I think now, and in all P2P, mainly the P2P, if we take Yellow Pages, Rexel, you have a significant debt push down, which are made even before the closing of the public offer. And I think all the lawyers now in Paris are quite comfortable that it doesn't raise really issue. If the financial burden which is put on the operational company, on the target company, complies with the financial means of the target company. So if the target company has the ability to repay. It's the same for recapitalization. At a certain stage, we had a discussion between lawyers whether it complies with the corporate interest of the company to borrow funds in order to repay shareholders' loans or even to reimburse a share capital. But I think also most of the lawyers now agree that this transaction, by definition, do not infringe the corporate interest of the company. Another point, I think, what we are seeing in negotiating in the documentation, what has already been said, is the liquidity of the markets. Now, today, you have more and more CLO, CDO funds, and even hedge funds which are entering into the syndication of this type of transaction. And so we see that today there is more sensitivity from the equity sponsor on all the assignment transfer clause, and I think it will be really a topic maybe in the next months, because there are clearly two contrary wishes or requirements from the bank and from the equity sponsor. The banks want to have, which is perfectly understandable, to have as much as possible the liquidity of the investment. So they don't want to have any control of the equity sponsor and not necessarily on the primary syndication, because generally the primary syndication is made, of course, in consultation with the equity sponsor, but it's more related to the secondary market of the debt. And on that, generally what wants the bank is to have as much as possible liquidity on their investment. And clearly today, I think it's, and you can understand that, but it's difficult for these two wishes to be compatible. For the equity sponsor, which is perfectly understandable, they want to also to have a certain degree of control with respect to who will be the holder of the debt at the end. In particular, since the transactions are more and more complex, and you have the ability to make build-up in the legal documentation, so they want to know who will be their interlocutors at the end in order to grant the waiver, for example, if they need waiver in the life of the transaction. And also another point, I think, which is related to the syndication, is the confidentiality. Sometimes you have also a discussion now with confidentiality exactly with respect to CLO, CDO. And in some sectors which can be quite sensitive, the management or the equity sponsor also wants to know to whom the financial information will be provided, and to be sure that if this information is provided to the investors, for example, in a CLO, CDO fund, they will be bound by any kind of confidentiality undertaking. So I think also that's something we will have to discuss in the near future, maybe with the equity sponsor. So with respect to the legal documentation, the liquidity of the market is really, I think, driven some clause, for example, as the ability to repay, the tranche B, C, D, and the possibility for the lenders under this type of tranche, which are the bullet tranche, to decline any early repayment because they have entered into the transaction because it was a long-term investment. And so mainly for me, the two trends of the markets today is, first of all, the strength of the commitment which is required by the banks in the financial documentation, with the certainty of fund, with the fact that more and more it is requested from the banks to declare in the commitment letter that all the CPs are more or less satisfied at the time of execution of the commitment letter. We have also this practice, which is more and more, which is now common, of the interim facility, which is to show that in any case, even if you are not in a position to sign the legal documentation, you have a binding commitment from the banks vis-à-vis the vendor to finance, even for a very short period of time, which can be 60 days, 90 days, but you have a firm commitment from the banks to finance the acquisitions, and that you can show this commitment to the vendor. And today I think it's a very important point in the competitive bid to have the strongest commitment from the banker, which really becomes in fact a partner of the sponsor in this process.
Rainer Busch, Mercury Partners. Richard mentioned that hypothetically there may be a slowdown in the debt market. In this slowdown, what may be the major triggers to a slowdown? What may be the extent of the slowdown, and what may be the timing of the slowdown? That's a question to everyone.
And please be very precise.
I have absolutely no idea, and if I did, I could make a fortune, probably. I suppose I just believe, having been in the leveraged finance business for 20 years, is that there's always been a credit cycle. No one can read cycles perfectly in any walk of life, but there's always been a cycle, and the more we're moving up, there's got to be something. Now, interest rates per se won't affect debt because it's capped, as François said, but they do affect business. And it's just the margin of maneuver that so many businesses have is so small when they're so highly geared that if there's some sort of economic downturn, it might not have to be huge. You could just get a slightly higher percentage of default. If the default rate starts to move, why is this asset class so attractive? The historic default rates are fantastic. So the question is there some tipping point where you have a certain number of deals which start to wobble, and everyone takes a step back and thinks about what they're doing, and then the sheep mentality starts to hit, and people go, well, actually, maybe, leverage debt, tranche C, this, that, and the other. Maybe it's not quite as a license to print money as we thought. But, I mean, I'm sure I'll sit here in a year and say the same, and 2 years say the same, probably. But at some point, it's like the stopped clock is right twice a day. Well, at some point, the credit cycle will move the wrong way. And I think the trigger will be a little bit of economic slowdown and 2 or 3 named deals having some problems.
I think the main question is, it will be a soft landing or a crash landing. I'm sure that it will.
Yeah,
No,
I agree.
I think that's the main question. We are all of us sure that you will have a landing, and my view is that you will have more a soft landing than a crash landing. And I think perhaps the main view will be perhaps to have, as Richard said, perhaps a little slowdown in the term of economic. Remember that, for instance, if you look for each year that you have an election in France to choose a president, it has been always a very bad year in terms of consumption. I don't know if 2007 will be a bad year in terms of consumption, but it's true that if you have a little slowdown in economic, some files could have some trouble, and after you will have perhaps a soft landing. Nevertheless, I am sure that if we repeat the video that we have done last year, we said perhaps, or we told you the same thing, and you told us the same thing.
One thing I picked up is this sentence about, the valuation is based on debt level, not on the underlying value of the business. And it reminds me of the 1999-2000 valuation when things were valued based on clicks and not on the underlying value of cash flows.
It's not as bad as that, I hope.
Not as bad as that, no.
I hope it's not as bad as that,
Okay.
because that really was crazy.
One thing, does the audience have a question? I had one for them. One thing also is, as those years go, every year you say it's a little bit of the same. It's going beyond last year, and we're going to the trends are deeper. And at the same time, I can't help thinking. So now it's actually completely different. The processes are so much shorter. The mezzanine are so much bigger. Everything's bullets. The bank don't keep and syndicate more. It's just a new. It's just a new world. And there's probably two different things that can happen. Like in the tech world, back to the old stuff after a landing, a hard landing or soft landing, or back to the old stuff, but we'll keep some of the good new stuff. How do you see the future based on this attempt framework?
Well, I mean, we're not going to go back to the what's happened has happened. So it's not going to go back to some lovely paradigm of debt to EBITDA, 3 times, 4 times, and purchase prices. So that's never going to happen again. That's not going to happen. I think we all hope that the landing would be soft, just a slightly higher percentage of troubled deals, and everybody just ratcheting down a little bit on what they pay and what they lend, and that's what we hope will happen. But I think that what's been invented can't be uninvented, and the changes in documentation, the fact the CLOs and CDOs and hedge funds aren't going to go away completely. So no, there's no going back to how it was 4 or 5 years ago. But it'd be interesting to take a situation from 4 years ago and compare to today, rather than last year and compare to today, and then you really will see a massive shift. Massive.
Hi, I'm Adrian Mellor from Overy in Paris. I was going to, sort of based on what's just been discussed on the market, I was going to do a rapid tour of what's new in the leveraged finance documentation as a result of the market changes. I can see a lot of experienced faces here, but some junior ones as well. Some of it may be passé to some, and maybe I hope there's some new issues here for others. So what is new in documentation and what's triggered the changes? I think we've heard a lot of this earlier on. I think the first and foremost is the competition amongst deals for lenders. Nowadays, the process is very much sponsor-driven. The sponsors prepare their first term sheets and prepare a very aggressive position, and lenders are basically left to be prepared as to be the who dares and who's most aggressive on the whole in documentation goes a long way to winning the deal with that sponsor. I think that precedent is king, in that if a deal has been done before with documentation that has aggressive terms, of which I'll come on to later, then that is very comforting to a bank in a deal, and they will look to that in being comfort for going forward on those terms in a new deal. So, in transactions, precedent, in my mind, is king in determining whether banks agree to certain points in the market. I think we're also finding that sponsors are preparing their own term sheets, and therefore there starts to be a more common approach to term sheets and points that are being raised in documentation, which to some extent also allows lenders to be more comforted in that other lenders have agreed to it, so syndication should be easier. Already mentioned, participation of CLOs and other non-banks has made an impression on documentation, that the number of participants in the syndicate have increased so much that voting provisions have to be looked at radically. The ability to take out banks out of deals also needs to be looked at carefully in case they don't vote at all, or they don't vote in the way a certain majority do vote. Also in the market nowadays, I think we see secondly and certainly, and perhaps less so, but we still see it, PIC facilities as part of the overall package, and that those tranches or those facilities also have an impact on the way documentation is put together from the outset. And finally, the impact of the auction process. Eric has already mentioned this point, in that certain funds is now becoming almost every deal has a certain funds clause in it. Whether or not it's a big deal, a small deal, a P2P, public, they have certain funds. And together with that, what we call interim funding arrangements, which also Eric has alluded to. So first of all, what are the established sponsor points as a result of these market changes? I think pricing-wise, one of the first things I'd refer to is reverse flex. Again, I'm assuming that most people here are aware of what that means, but it seems to me that on a successful syndication nowadays, that the sponsors want to see some reduction in margin where there is oversubscription on certain tranches, and that is a relatively new concept. One perhaps which is a bit more present in the market for more time has been no commitment fees prior to financial close. There used to be the old ticking fee that once mandate letters were signed, that commitment fees ran from day one at some level. That now seems to be pretty much removed from the market. I also refer to what's a two-way margin ratchet. Again, this is another point whereby often in previous deals, the quarterly accounts and the ratios run off those would determine the margin rate. And if the annual accounts were different and actually determined there being a lower or higher rate, the banks wouldn't agree to going to the lower rate. Nowadays, it's pretty much common that if the margin on the annual accounts do show a lower rate, then that lower rate is agreed to by reducing margin going forwards. The final point I wanted to raise is no deal, no fees. Again, I think that is a new part and hallmark of all transactions nowadays, that if the deal doesn't complete, then no one gets paid, including you and the lawyers. The final point, interim funding arrangements, which Eric's alluded to, I just thought was worth spending a couple of minutes on, because I think lots of people do ask and are concerned about how that should be documented. And I think there are various ways which that happens nowadays. I mean, the ultimate point of an interim funding arrangement is to put the lenders on full commitment without any ability to renegotiate the documentation. So basically, a lender is basically alive and committed without their commitment being subject to documentation. That ultimately means that you are, from day one, in theory, bound to fund the deal off the back of some form of term sheet or very short form document. That in itself is not satisfactory neither to the lenders nor to the sponsors on the whole. So there has been some move in the market nowadays to try and have an actual full form facility agreement in place from day one, or to have a very, very full form term sheet, so that at least that the majority of covenants and the majority of the terms are clear from the outset, rather than having a rather flimsy commitment, but nevertheless a clear funding commitment from the lenders. This really results in heavy negotiation at the outset, and reductions of some of the terms and conditions, such as extensive covenants and reps and warranties, but nevertheless fairly heavy documentation from the outset. Ultimately, I think the point with these interim funding arrangements is that no one actually wants to use them. They are there for the sponsors to win the deal vis-a-vis their seller, and to show they've got very strong commitment, and in theory could fund if needed to in the period required to buy the asset. So what other common sponsor asks are there, based on the discussion we've just had? I think prepayment fees. There's a strong element now in documentation whereby the prepayment fees payable on mezzanine or other facilities are being negotiated out or reduced down, particularly if there's a refinancing likely to happen or potentially could happen, which clearly is going to be a large cost to the sponsor and the company. So in those circumstances, these fees can be seen to be waived from the outset. Second point is whether the majority senior have the right to disagree with a prepayment of debt which is subordinate or junior to them. You see this coming through either as a general rule that junior debt can be prepaid without majority senior consent, or on an IPO, proceeds coming in from an IPO being applied first towards junior debt before it gets applied towards senior debt. I think a fairly common theme nowadays is no guarantor coverage test. In the past, we used to have this idea that there was a coverage test of around 85% or some proportion of the group providing guarantees. And I think now with that, something again is being pushed hard by sponsors to take out of documentation. Final point is, I think, great operational flexibility. Generally, acquisitions and investments start to be more and more widely permitted in documentation, particularly on mandatory prepayments, which I'll cover in the next slide. In the past, mandatory prepayments such as disposals or insurance proceeds, etc., which would be used to prepay the banks, the approach generally taken now is that the company has the right to reuse those proceeds to reinvest, and fairly long periods in which to do that, from up to 6 months in some cases, to reinvest proceeds, rather than those proceeds being used to prepay the banks. More technical point is the application of voluntary mandatory prepayments. In the past, voluntary mandatory were applied in the same order. Nowadays, voluntary prepayments pretty much at the discretion of the company, whereas mandatory prepayments is defined in a more strict order. And Eric alluded to that as well in his presentation. Other points, I think control pre and post IPO. There's a distinction made in documentation nowadays that chain of control provisions triggering mandatory prepayment are different pre and post IPO. And also, I think an important point is an excess cash sweep step down. Basically, the excess cash sweep, which we usually apply towards mandatory prepayment in some proportion, 50% from the outset, steps down depending on leverage ratios going forward, if not taken out completely from the mandatory payment clauses. A quick word on equity cure rights. These are pretty common nowadays in documentation to provide for the right, if financial covenants are breached at any stage, that the sponsors have the right to put additional money into the company to cure them. The old motto of throwing good money after bad, is obviously the lender concern, but on the whole, this is becoming part of documentation nowadays. The main question, I think, for lenders is to consider carefully what that equity injection should be used for, and what does it count against. Particularly to be careful of double counting. That if that equity injection is going to be applied towards reduction in debt and increase in EBITDA, clearly less equity needs to be put in. So careful thought needs to be put in place to what that equity injection should be applied towards. The other point I think is important, due to the size of the syndicates nowadays, are the voting provisions in documentation. We're tending to see, or this is I think relatively new, that some of the voting majorities, which traditionally have been 2/3 of facilities, are being reduced down to 50% in order to allow amendments and waivers, etc., to be granted more easily. Yes, I've also seen between facilities the senior having a 2/3 majority vote, whereas the mezzanine has had a 50% majority vote, in order, again, to try and get decisions made quickly by the syndicates. To deal with the same point, we have these terms, use it or lose it, which is basically a deemed consent vote. If you don't vote, you're treated to have voted no. You're deemed to have voted yes. And yank the bank, in that if you vote no, whereas the majority have voted yes, you can be taken out one way or the other with equity or transfers to a new lender. This also links into releasing of security, rather than that being a traditional 100% vote or relatively high proportion. That is being pushed back to a lower threshold to allow release of security and guarantees to take place without individual lenders blocking that control right. Continuation of the same point, consent release of security is being reduced down to levels around 75%, 85%, or yank the bank clauses are prevalent. Also, from the outset, in order to avoid unnecessary control from the syndicate, security principles are being agreed in great detail from the outset, in order to make sure that those can be complied with and used throughout the documentation without consultation from the syndicate. And finally, timing for giving of guarantees and security. Often with large deals, large acquisition finance, it's very difficult to put in place the full security package from the outset. So there is some degree of request by sponsors to delay the giving of guarantees for some period after closing. I think those cover the main points that we're seeing due to the change in the market. So anyone has any particular question on them, obviously feel free. Thank you.
Well, I mean, to me, what's interesting are the voting provisions in terms of the wide syndication. And are you saying that in terms of things that generally needed unanimity, the really serious stuff, are you seeing moves in that direction?
Yeah, certainly in releasing security and guarantees, we're seeing a large push not to have 100% control, but a supermajority type of control, some way between 2/3 and 100%, or the concepts of Yanker Bank, etc., are available in order to take out banks should they not agree to releasing security or guarantees. But it's certainly becoming more prevalent in the documentation we're seeing. Yeah.
We spent less and less time, to negotiate this loan doc, if you compare some years ago. Nevertheless, the only point that we try to block today as a lender is all the clause regarding the syndication. I mean that perhaps is the last part of the castle which has not been touched by the private equity. We try, to resist, for instance, to some private equity. We ask us to have to keep a right, on what we want to do on syndication, which edge or not edge to have in our syndicate, and so on. Today, it seems that we resist. I don't know what's the idea of my colleague from Calion, for instance, but it seems that we try to resist.
Leverage finance used to be leverage finance, and now it's a bit of real estate finance, and it's a bit of capital market finance, and it's a bit of asset finance. Mm-hmm. What is leverage finance? What is it going to be? And how does it impact your way to frame the issues and lend? And how do you see it going forward?
I will say that if you look at our organization, we are more and more in global banking. So we have this new concept which arrived 3 years ago or 4 years ago. And it means that we are working more together with asset team, asset finance team, property team, and so on. And we try to deliver, more and more complex deal with 2 or 3 sort of product. You have leverage plus securitization plus sometimes asset. I think Fréquin will be if you have a deal on Fréquin, but if you have a deal of Fréquin, it will be a very good example to have these 3 kind of product.
I'm in a different world. We're not a global bank, so we do what's called sticking to our knitting. We see real estate as something separate, a separate skill, and clearly we don't understand capital markets. So clearly there's I think a big deal mentality where these things are getting very, very enmeshed together. But at the smaller end, then we're in another world. Where we certainly start to stick to our knitting, but probably the more assets there are, the keener the banks and the less room for a little independent mezzanine like me. So maybe that's the answer, is that where there are these opportunities, probably we're not going to get the telephone call.
One big change that maybe seems small today, though the pace they've done it seems seems pretty interesting, is European capital. American capital as a whole, and other BDCs in the States. Last time I looked at the stats, I think 10 years ago they had like 1% of the Mets market, and before you know it, they took like 15-20% of the Mets market, with a very interesting concept, which is actually changing the market in big ways, especially the Mets market, but probably impacts the other pieces of the puzzle. And that's having a listed fund, that's doing full buyout, that's a pace which is pretty outstanding, and just to name a few, the way they refinance as well. I think they work with RBS, not only Bank of America also. How do you see this new kind of industry play and this new industry structure?
I will say two things. First, I think one main change into a 6 perhaps is the massive coming from the States, large equity house who now are big player like TPG and TDF and so on. I think it's just the start. I am sure that you will have more and more very large equity house working on in France, on the French market, with American bank. I think our main competitor today are the American bank. Why? Because they are working with TPG, with Blackstone, with KKR and so on. And we know all of us that they are looking on our CAC 40 and so on some assets. On European capital or American capital, today they are very keen. I will say today they are very nice. We are happy to have them in our syndicate and mainly in the mezz. We say more on the mid-market, to be fair. Not sure that tomorrow they are not competitor. Today they are very keen, but I am sure that tomorrow they will be competitor. But it's okay.
Thank you very much to all of you.